Hi, welcome to Bond Bytes, the daily bond market highlights from INR Bonds. I'm Arjun Patsati. And in this daily bond market highlights, investors seem to be stuck with long maturity tax-free bonds. And I'll tell you why just in a while. Before that, download our app, Quick Invest by INR Bonds, iOS and Android, where we give you the most information on a curated list of bonds along with our proprietary risk score that gives you the exact level of risk that the bonds are trading in the market at. And this will help investors and financial advisors calibrate their portfolios for fixed income for best returns with risk adjusted returns. Download the app now.
It was a tough journey going from an intern to a senior professional. Now, to protect my savings against high inflation and grow my wealth, I invest in bonds with INR Bonds. Download the INR Bonds app to save better.
Back to bond market highlights. Gsec yields were higher as the rupee fell. It's hovering around rupees 80, like record lows. It's a matter of time before it falls below that. But how equity markets have been doing well for a while. Sensex and Nifty have been higher, trending up. While US Treasury yields also moved up, where today UK inflation came in at record highs of 9.4%. And coming back to tax-free bonds, the 2028 to 2035 maturity tax-free bonds. Tax-free bonds have been issued by all PSU issuers, where they were some time back, where they were given they were given access to tax-free bonds by government so that they could raise funds at cheaper levels. But this has been stopped. And these tax-free bonds found a lot of favor with ultra high net worth and high net worth and corporate treasuries because they were searching for tax-free coupon income. And many of these bonds were issued at good levels, over 7%, all the way up to 9%, at that time, almost 10 years back. And many of these bonds are now trading at around 5.5%. But most importantly, in the last 2 years, we saw a lot of investor interest in these tax-free bonds at levels of around 4.5%. That's because interest rates were ultra low. And INR bonds did put out a lot of information on tax-free bonds and also warned investors again investing in the long maturity tax-free bonds because these bonds are illiquid because only one segment of the investors that are buying into the bonds. And now there is a lot of selling interest by investors, but buying interest is not there because the yields have gone up very sharply. In the 10-year Gsec yield has gone up from 6% to 7.5% levels and threatening to go to 8%. A lot of issues for the interest rate market. And even more important, on a tax adjusted basis for many of the investors, including corporate treasuries, they're no longer looking attractive at 5.5%, especially with interest rates looking to move up. And so hence with all this, the long and maturity tax-free bonds are seeing a lot of selling interest and they're becoming more and more illiquid in the market because there's all the investor segment is only selling the bonds and very few are buying these bonds. The short maturity tax-free bonds are reasonably well covered. They are still good. They are still seeing some interest because short-term rates are still attractive at these levels for investors paying high tax. However, long maturity bonds are becoming more and more illiquid. Thank you for listening in. Do not forget to register for our webinar on the 27th of July at 4 p.m. Wednesday, where I'm going to talk to you about what bonds to avoid. And clearly, one of the main bonds to avoid is the long maturity tax-free bonds, because I will explain to you exactly why in the webinar and many more such bonds where investors need to be very careful on their investments. Thank you very much for listening in, and do not forget to subscribe to our YouTube channel if you have not done so already.